How awesome would it be if you never had to pay Uncle Sam, you never had to pay Donald Trump, never had to pay the federal government a penny of what you earn? I know that when we look at our paychecks, a lot of the time, a lot of people get really pissed having to pay for different things that we don't believe in because the government has so much money and spends our tax money on so many different things that we're bound to feel like some of them are waste of money. And there are ways to be able to shelter your investments and your earnings from having to pay taxes to them. And that's what I'm going to go over this video. There are some YouTubers that have gone over this, but some of the YouTubers that talk about being tax-free, like Stephan, he's done videos on Roth IRAs, but it's not necessarily tax-free because you have to pay taxes before you put it in these accounts. What I'm going to talk about is what they talk about and why it's not necessarily tax-free, but then I'm also going to talk about the real ways to never have to pay a penny. So from the time that you earn money, let's say you make $20 an hour, and then normally you'd have to pay taxes, let's say 20% taxes on that, so then you're only at $16 an hour. No, you can take money from their $20 an hour, put it in these accounts, convert it to a different account, and then take it out of that account without having to pay taxes. So watch through to the end because I'm going to go through each way that you can go about that and how to not pay taxes on your money. And I think it's quite amazing and could save you potentially tens of thousands, if not hundreds of thousands of dollars. How's it going, everyone? It's Sam. This is going to be how to become a tax-free millionaire and actually become a tax-free millionaire. So the title is not too clickbaity because Stephan and even Meet Kevin a little bit have gone over how to become a tax-free millionaire a couple different times, and for Graham it was one of his best videos multiple times. He's made multiple videos on it, and he went over how to use a Roth IRA to become a tax-free millionaire, which is partly true, but I'm gonna break it down why you still have to pay taxes the way that he's saying it. And there are a couple different ways that you can go about becoming a tax-free millionaire that I think are much more beneficial and really you never pay taxes from the minute that you earn money to the minute that you spend it. So we're gonna go through that, but before we do, if you don't mind hitting the like button and hitting the subscribe button if you haven't hit that, and also if you want some free stocks, there are links down to WeBull in the links below. So let's get started. So in Graham's video here, he talks about how to become a tax-free millionaire with $12 a day, which is a great title. It makes sense. He goes through what a Roth IRA is. And if you don't know what a Roth IRA is, it is an individual retirement account where you put money in that's already been taxed and then you never get taxed again. So typically, let's say you have a brokerage account that's just a non-taxed advantaged account. You make money from your day job, you pay taxes on it when you get it from your day job. So usually those are taken out before you even get your paycheck. Put it into the account, it earns interest and grows in value, and then when you withdraw the money and sell some of your stocks way down the line, you have to pay taxes again on how much money you've earned from those stocks. So you have to actually be taxed twice. So what a Roth IRA is you still get taxed originally from your employer, but you put in this money to the IRA, and then when you take it out, when you're 59 and a half or older, then you don't have to pay taxes on it. So it's a great way if you think that you're going to be taxed more in the future, you'd rather pay the taxes now and not have to pay them later. Let's say you make $500,000 when you're older and then you're in a higher tax bracket, you would have to get taxed more. So it's better just to pay it now. Now, something that Meet Kevin did was he sold some of his stocks recently and he did what's called tax loss harvesting, where he had two stocks, Delta Airlines and Simon Property Group, and both of them went down in value. So they were pretty closely related. He noticed here on the chart that they go up and down at the same time. So this was just in a normal brokerage account, and he sold one of them and then put it all in the other one. So he lost, let's say, $50,000 in one of the stocks. He can use that to write off on his taxes that he lost $50,000 in stocks, because you can do that. But then he just moved it to a different stock. So you can't do that you can't just take it out of the stock and then put it right back in. It has to be moved to a different holding. So he did that and he was able to write some of that off on his taxes. But then eventually when it goes back up in value, he'll have to pay taxes on that. So those aren't the best ways to get around having to pay taxes. And I'm going to show you the next one that a lot of people use. And you still have to pay taxes originally, but it's really nice not to have to pay taxes long term. And then I'm going to show you the way that you can literally never have to pay taxes, and that's called the Roth conversion ladder. And it's quite amazing. It was awesome when I learned about it the first time. The next way that people typically never have to pay taxes is by rental real estate. So we won't spend too long on this just because a lot of people probably know this, but you can write off mortgage, interest, property tax, operating expenses, depreciation, and repairs. So I made a little chart. Let's say you have a home that you buy for rental real estate. It costs $275,000. You put 20% down for the down payment. So then you have a mortgage left of about $220,000. So I broke down the numbers. Let's say you have that mortgage at 4%. You have about $1,050 for a mortgage payment. You have property taxes, insurance, repairs, vacancy. Altogether, it's about $1,600 a month. So let's say you're getting $2,000 in rent. The portion of your principal and interest for the first year is $720. So then you also have principal pay down, but you can write off the interest on your taxes. The other thing you can do is write off your property taxes, insurance, repairs, vacancy. Then you can also depreciate the home over 27 and a half years. So what this is, you take the home value, you divide it by 27 and a half, so that way you can depreciate it equal amounts each year. And then I divided it by 12 for each month. So you can essentially depreciate the home over every month since you have it. So that equals about $833. So your total write-offs from all this are about $2,100. So again, I'm not a financial advisor. I'm not a tax professional. I'm not anything like that. So make sure you do your own research. Talk to your accountants if this is something that you want to do. But essentially, you could write off $2,100 worth on this home, even though you're making $400 a month. So it only costs you $1,600 to actually have this home. You're getting $2,000 in rent, and then you can write off $2,100. You can do this for 27 and a half years, and then you can't really depreciate anymore because you're down at zero because you've depreciated it every year over 27 and a half years. But then you can do something called the 1031 exchange. We won't get into that, but that's the way that a lot of people get around having to pay taxes on real estate because there are a lot of tax incentives. Now, this isn't really the best way because you still have to pay taxes on the money that you originally received to pay for the down payment, unless I guess you had other rental properties that you didn't have to pay taxes on because of something like this, and then you use that money to buy real estate. But that's a rabbit hole that could go on forever. So it's a great way to not have to pay taxes. But the number one way is called the Roth conversion ladder. And this is something that not many people talk about. I think maybe because it's a little bit more complex than a lot of people want to get into. This is how you do it. And shout out to Mad Fientist because he was really one of the pioneers that did this. He was maybe the first person that really made it public that you could do this. And he spent hours going through like IRS documents and different forms to figure out that you could do this. So you can contribute to pre-tax retirements each year during your career to reduce your taxes. So like your 401k, traditional IRA, 457B, whatever you have available. So let's say you put $5,000 a year in your 401k. Contribute to that consistently. When you put money in that, it's untaxed. So you take it before taxes and put it into those accounts so that it can grow tax-free in there. You retire early. Let's say you retire at 45 or something, or 30. It doesn't really matter. You retire early. You can then transfer your employer's retirement accounts, so your 401k, 457B, 403B, any of that, to a traditional IRA. So a traditional IRA is pretty much the individual retirement account version of a 401k. So they're essentially the same thing. They have different contribution limits and they're set up differently. So one is really so that anyone can do it, which is the IRA. The 401k is for employers to be able to help you save for retirement. So you can transfer it over to the traditional IRA. So it's not technically a deposit or anything like that. It's not a contribution, it's a transfer. So it goes from untaxed to untaxed. So neither of them have been taxed at this point. And then what you can do is you can convert each year from the traditional IRA to a Roth IRA. You can convert. Now the thing is you have to pay taxes when you convert, but if you come under these tax brackets, we have really favorable tax brackets right now in the United States where there are certain limits that you can make money in capital gains, which is how much your stocks have appreciated over time or gone up in value. and in dividends each year without having to pay any taxes on it. So let's look at this for a second. You can, in 2020, you can make $80,000 from capital gains or dividends and have to pay $0 in taxes. So let's say you're married, you've been both contributing to your 401k for a while, you retire early, then you transfer your 401ks to a traditional IRA, and then you start converting $80,000 a year. Let's say you don't have any other income, let's say that you're really truly retired, you can convert $80,000 a year from that IRA over to your Roth IRA, and once it's converted, you don't have to pay taxes on that conversion if it's under $80,000. And then once it's in the Roth, it's untaxed, right? So you can start converting. There are some rules to that. So after you convert to your Roth IRA, you have to wait 5 years before touching the money. If you convert it, let's say you retire at 45, you convert it when you're 45 and convert it over, you have to have 5 years worth of, let's say, some kind of money on the sidelines. Let's say you saved up $300,000 just in a normal account, or better yet, you have a brokerage account or something like that. You start pulling out of that brokerage account. So you start draining that while you're waiting for this 5 years. And then each year you convert $80,000 over to that Roth IRA. And then you start taking out, let's say at 50, you can start taking out the money out of that Roth IRA, and you don't have to pay taxes on it then. So you saved in your 401k for years, you retire early, you then convert your 401k to a traditional IRA, then you start taking money every year out to go into your Roth IRA, which I know there's a lot of different IRAs and 401ks I'm throwing out there, but stick with me here. You can rewind if you have to. So traditional IRA then gets converted to the Roth IRA. You're taking money out of other accounts and stuff like that so that you can wait 5 years for this money to settle in the Roth IRA, and then you can take it out tax-free. So it's been tax-free the whole way through, and you never have to pay taxes on it, never give a dime to Uncle Sam, and you can take your money out without ever having to pay taxes on it. I think this is amazing that we can do this. It's kind of a loophole in the system, but I think that some people just don't think that this is enough money. Like, for me personally, I think that $80,000 is a lot, but if you live in New York, LA, Florida, I don't know, some of those other high cost of living areas, if you're 25 or 30 or 35 and you're like, oh man, I make $200,000 right now, I can't imagine having to live on $80,000, or maybe when I grow older I want to be able to spend more money. I can understand that, but something to keep in mind is this goes up pretty much every year or every couple of years. So these are pushed higher and higher each year. So I'm 24 now. By the time that I get older and might have to actually take money out, let's say in 20 years, this could be 120,000. This could be 150,000. We don't really know, but it's going to continue to move up over time. So if you think this is low now, it's probably going to be bumped up higher. So I wouldn't worry about that too much. The principles are really sound right here to be able to do this. And this is one of the best ways to take money out. I'd say it's probably the best way to take money out tax-free. So if you were able to, let's say, contribute to your max amount in your 401k, so $19,000 a year, and then maybe also you contribute to your Roth IRA or a brokerage account, let's say, so you contribute to a brokerage account, so that way you have money for the 5 years that you're converting over. And maybe even, if you're able to, you have some rental units too. So you buy a couple rental units with your extra money. You don't have to pay taxes from those rental units. And then you can continue to do that. Maybe once you retire, you sell off 1 or 2 of your rental units if you just don't want to deal with it. And then you can take that money from the rental units. You might have to pay taxes on it when you sell the home. But then you can use that money to float you until you're able to start withdrawing from your Roth IRA that you're converting. So there are tons of different ways to go about it, but I think this is one of the best ways to not have to pay taxes. So thank you guys for watching. I appreciate it. I hope this wasn't too jargony. I know that I threw out lots of 401ks, IRAs, lots of numbers, but hopefully you understand. If you don't, let me know in the comments below and I'll answer any questions that you have on it. Again, I'm not a tax advisor. I'm not a financial advisor. I'm not an accountant, nothing like that. So take what I say with a grain of salt and do your own research. But I appreciate you guys watching, and I will see you in the next one. Bye.